It is that time of year again. We are winding down what, in many ways, has been a very surprising and interesting 2023 for the housing market. And now that we know what's happened over the course of the last year, we can start to look forward to what might happen in 2024. So in today's video, I'm going to break down the major variables that are going to be impacting the housing market in 2024. We're going to examine a couple of different scenarios that may play out given all the economic uncertainty. And we'll also talk about what you as an investor can do to grow your business even during an uncertain economy. Well, I know everyone is eager to hear what might happen in 2024, but before we go into that, we have to look back and consider what happened in 2023 and how we arrived at where we are today. About a year ago, in the last quarter of 2022, the housing market was entering a correction. And for many, myself included, felt that the market was going to go down on average, on a national average last year. I said I thought it would go down between 3 and 8%. But I was wrong. When you look at what's happened so far, at least in 2023, and I am recording this using August data because housing data lags a couple months. So even though I'm recording this in November, we're using August data. But as of August, prices in the housing market were up by a little less than 3%. So this isn't any booming growth. This is actually close to an average year of housing market growth, but it was higher than at least I personally expected, and I think that a lot of forecasters and economists expected as well. So we should identify what has happened that led prices to stay as resilient as they have been. And the first thing was demand. Personally, I felt that with interest rates continuing to go up, and I thought the economy would slow more than it did, that demand would get pulled out of the market, and that would send prices down a little bit, modestly. I never thought there was going to be a crash, but I thought they'd go down a little bit. And that actually happened, at least the demand piece. Demand has dropped 15% over the last year. It's actually down 40% from 2021 highs, and it's at the lowest point it has been since 1985. But what I didn't fully account for, but happened, was that supply actually continued to drop. During the pandemic years, we had really low inventory, which is what we call supply in the housing market. But as interest rates rose, it didn't just pull demand out of the market. It actually pulled supply out of the market. Supply is down about 12% this year and is actually down 45% from its 2021 highs. So if you take those two things I just said into account, demand is down a lot, 40%. But supply is down actually more. It's down 45%, and that's why prices have stayed stable. If you know anything about the rules of supply and demand, when these two things happen, when supply and demand fall proportionately, prices can stay relatively flat. But volume, the total amount of homes that are sold, will decline. And that has absolutely happened. We have seen a 50% decline in home sales since July of 2021. I like to think of the housing market as a scale. Of course, prices are dictated by supply and demand, but there are a lot of things that go into supply and into demand. And in this chart, everything that's green is really impacting demand the most in my mind. So we talk about things like migration patterns that ticked up during COVID. That was important, but it's kind of shrunk in its importance over the last year or so. Demographics have given a strong demographic tailwind for the last several years, and that is important, but it's not as important as the two biggest circles on my graphic here, which are affordability and inventory. Those are the things, like I said, that sort of impacted the market in 2023. Rising mortgage rates brought affordability down, and that started to exert downward pressure on prices. I thought that would be more significant than the upward pressure from low inventory, but I was wrong. Inventory was actually the heavier weight, using my scale analogy, and prices have gone up modestly. So now when we look forward to 2024, using this scale that I have here, we have to ask ourselves, which of these variables that impact housing prices are going to change? Migration, it's slowing down. I don't think it's going to change all that much. Housing tenure, it is very important. It's gone up slowly over the last decade, but it just doesn't move that quickly. Demographics, those just don't change. That's how old people are. You can't change that. What about inventory? That has obviously been the dynamic in 2023. Now, will that change in 2024? Will we start to see more inventory come online? Now, the main reason most people theorize that inventory has remained so low over 2023 is known as the lock-in effect. And this is the basic idea that because over 90%, actually 92% of people with a mortgage have a rate locked in under 6%. As of this recording, mortgage rates are right near 8%. And the housing market is unique because people who sell their home, 70% of people who sell their home actually go on to buy a second home. So when mortgage rates are as high as they are now, not only does it dissuade buyers, it also dissuades sellers because they don't want to sell their home only to go on to buy a new home at a much higher rate. And so this is the lock-in effect and really has dominated the housing market over the last year. But will it break in 2024 is the question we're trying to answer. Well, we don't know, but John Burns Research and Consulting, a great real estate data firm, did some research and they showed that this lock-in effect is unlikely to break until mortgage rates approach 5%. And personally, I don't see mortgage rates getting that low in 2024. Just as a matter of fact, Zillow also did a similar survey. Their data was almost identical. So now we have two surveys saying that the lock-in effect probably not going to break until we get close to 5% mortgage rates. If you think that is going to happen next year, then maybe the lock-in effect will break. Personally, I don't think that's going to happen. What about other things that could increase inventory, like foreclosures? Well, foreclosures have been ticking up since their 2021 low, but they're still extremely low. If you look at this data from Adam, you can see that in 2023, mortgage rates year to date compared to year to date in 2019, the year before the pandemic, are still significantly lower. And these are not even close to where we were during the Great Recession. It's actually about 1/9 of where we were during the Great Recession. And so I do expect foreclosures will continue to tick up. But the numbers that they're going to go up by are not enough to really change inventory dynamics, in my opinion. The other thing, or the last thing that can impact supply is, of course, construction. And although construction is in a decent place right now, as of today, you see declining builder confidence. And that means building is probably likely to slow down. And even if building stayed at the same rate we are in today, it would probably take several years to eliminate the long-term housing shortage that we have in the United States. So when I look at all these things together, I think the most likely scenario is that supply is going to stay relatively low in 2024. I bet it will tick up a little bit. I'm not saying that's going to stay as low as it is now, but when I'm trying to make a forecast or think through what could happen in 2024, I don't think there's going to be any industry market changing levels of supply change in the next year. What about affordability? That was the other big circle on our scale, remember. And if you don't know what affordability means, it's basically how easily the average American can afford the average price home. And within affordability, there are basically three pillars or three variables that you need to think about. The first is home prices, which right now are relatively stable. As I told you, they're up nearly 3% year over year. The second thing is wages. How much money do people have to pay for their home? And wages for the last several years have not kept up with inflation. So they, in real terms, which is inflation adjusted terms, they have been down over the last several years. That dynamic has just started to shift just slightly over the last month or two, but I don't see wages growing so much faster than the rate of inflation that it's really going to make homes all of a sudden more affordable. Which leads us to our last pillar, which is mortgage rates. And as we all know, mortgage rates are incredibly volatile, and as you might guess, are probably the key to the housing market in 2024. I personally believe, because I think supply is going to stay relatively similar, I think affordability is really the big question mark. And within affordability, mortgage rates is the key variable that we need to look at. Okay, so if you're following me and you also agree mortgage rates are sort of going to be the key to where the housing market goes next year, we need to talk about where mortgage rates are going. And unfortunately, we don't really know. No one knows what's going to happen because rates are really complicated. Yes, they are influenced by the Federal Reserve, but they are not set by the Federal Reserve. They are also influenced by people who invest in bonds and investors in mortgage-backed securities. So this is really complicated because you have to understand where rates are going to go. You have to think about Fed monetary policy, demand from bond investors, and demand from mortgage-backed securities. And if you think about what those investors are thinking about, they're also thinking about their risk-adjusted returns in the stock market, whether they should be putting money in cash or gold or commodities or all these different things. So it really is complicated. But for the purposes of our conversation, I think we can boil it down to two variables because we have to sort of think through, if we're going to try and forecast what's happening next year, we have to think through which variables are really going to be the key drivers. And to me, when you look at the Fed and MBS investors and bond investors, it's really going to come down to inflation and the labor market. Now, I say this for two reasons. First, the Fed. When you look at the Fed, they have a dual mandate from Congress. They have two jobs. One is to quote unquote control price stability, which is just a fancy way of saying controlling inflation. Their other job is to quote unquote maximize employment, which is another word for just growing the economy. So when you think about Fed policy, they are attacking one of their mandates right now. They are really working hard to control inflation. And so far, the labor market, and I'll talk about labor market data in just a second, but so far, the labor market has performed relatively well, at least according to the metrics that the Fed follows. And so the Fed doesn't need to stop raising rates, or they probably will stop raising rates, but they don't need to lower rates until unemployment starts to go up. When you look at bond investors and MBS investors, demand for MBS and bonds typically goes up when there is risk of a recession, where investors want to put their money in safe assets. And right now, again, according to the metrics that investors look at, like GDP and the labor market, there isn't as much of fear of a recession as there was a couple months ago. Just the other day, we got data about GDP in the third quarter in the United States, and it was up a whopping 4.9%. But that is as of right now, right? That is just where we stand today. And a lot of this could change going into 2024. There are tons of headwinds facing the economy right now. You see student debt repayment, you have a lot of geopolitical instability, and I don't personally think that we've fully felt the impacts of all the interest rate hikes that we've seen over the last 18 months. Okay, so I like to boil this down to inflation and unemployment for two reasons. And it's basically because when the Fed makes decisions about monetary policy and investors and mortgage-backed securities and bonds make decisions about how to allocate resources, these are often the things that they think about. The Fed has this dual mandate to control inflation and fight unemployment. So these are the two things they're going to be thinking about. Meanwhile, for bond investors and mortgage-backed securities investors, inflation is one of the biggest risks to their returns, and recessions or high unemployment also change the calculus for them to risk-adjusted returns. Should they be putting money in safe assets like bonds, or should they be putting money in risk assets like stocks? So these are the things that the people who will really influence mortgage rates are thinking about. Basically, anything could happen right now. Next year, all of these scenarios are on the table. Mortgage rates could go down, but that is likely going to be the impact of a recession, or at least a broad economic slowdown. Even if the National Bureau of Economic Research doesn't decide to call it a recession, it still might send mortgage rates down. In this scenario, if inflation starts to come down a little bit, but unemployment goes up, the Fed will have cover to start lowering rates, and the demand for mortgage-backed securities and bonds will go up, which will send down bond yields. So that could bring down mortgage rates in 2024. That is a very reasonable scenario. But be warned, if you're rooting for low rates, that will probably come with a significant economic slowdown. Of course, on the other end, mortgage rates could go up. And that will be a product of an economy heating up or staying as hot as it is now. In this scenario, the Fed will have inflation too high. And I believe them when they say they're going to keep rates higher for longer, and that will impact mortgage rates. And if unemployment stays as low as it is, or maybe even goes lower, then demand for bonds is going to decline, and that will push mortgage rates up even higher. So mortgage rates could go down, they could go up. Or there are a lot of scenarios where we stay in this economic purgatory that we're in right now, where we get some encouraging inflation data, some encouraging labor market data. Then the next month we get bad labor market data and bad inflation data. And in that scenario, mortgage rates are likely to stay steady. And now I know I've basically said that next year mortgage rates could go up, they could go down, or they could stay steady, but that is the only honest answer, right? In this video, I've been trying to identify the things that are most uncertain so we can keep an eye on them in 2024. And to me, mortgage rates are them, and we have to be honest that no one actually knows where they're going to go. But if you want to be an investor and to invest successfully in this kind of environment, you need to at least come up with a hypothesis or an investment thesis, right? We can't just say we don't know. What you need to do is say, I think this ABC, XYZ is the most likely scenario, and I'm going to build my investing business around that scenario. And I also acknowledge that these other scenarios are likely possible, and I'm going to come up with a backup plan in case one of those futures comes to fruition. So let's talk about what I personally think is the most likely case. I'm going to call this my base case. And I honestly think it is a continuation of this economic purgatory that we're in. Inflation has come down a fair amount, but getting to that 2% target, I think, is going to be tough. And I think they're going to keep hammering on inflation until the labor market breaks. Now, personally, I do think that the labor market will crack. I think it has been remarkably resilient, but I do think we'll start to see unemployment start to tick up, but not in the first couple of months of 2024. As of right now, there are over 9 million job openings in the United States, and it's going to take a little while for interest rates to continue cycling through the economy. And so what I think the most likely scenario for 2024 is that affordability, mortgage rates are going to stay high. They may even go higher. And affordability in the housing market is actually going to get worse. And I think that is going to send demand down. And I think we might see weakness in housing prices over the next 3, 6, maybe even 9 months. But then at the second half of 2024, because if the labor market breaks, again, if the scenario where mortgage rates start to go down and improve affordability is if the economy starts to falter. And I do think the economy will start to falter at some point in 2024. And that will probably bring down mortgage rates and increase demand. And I know some people think, oh, it's a recession, there's no demand for housing. That's not the case. If you look at the last 6 recessions in the United States, housing prices grew during 4 of them. So it is not unheard of for housing demand to go up during a recession because that's when it is most affordable. And that's what I think we're going to see. Rough first half of 2024, better second half of 2024, at least as it relates to the housing market. So that's what I think is going to happen. And I think we'll see prices at the end of next year relatively flat. I'll call it plus or minus 4% next year. And I know that's a wide spread, but there's a lot of uncertainty right now. Certain markets are going to go down a couple points. Certain markets are probably going to go up a couple points. But I don't think we're going to see a lot of movement even to the downside or to the upside. But that's just my most likely case. What about an upside case? Is there a case that housing prices go up? Yeah, I definitely think that happens, right? Because my hypothesis is that housing prices will go up if the economy starts to do poorly, right? So if unemployment goes up, if GDP goes down, we enter a recession officially, or maybe it's not official and we just all know that the economy is doing poorly, that could actually lower mortgage rates a lot, and that could increase demand in the housing market. And as I just said, there is a lot of precedent for this. Housing prices often go up during recessions. So I think there is a very good case to be made that housing prices will go up. What about a downside case? Could prices go down? Yeah, that could also happen. Of all 3 of these scenarios, I think the case for housing prices to go down more than 4% next year is the least likely, but it is still a relatively likely scenario. In this case, the economy stays too hot, right? Inflation is really stubborn and the Fed does not want to lower rates. The labor market may budge a bit, but not enough to force the Fed's hand. The Fed keeps rates high, yields stay high because there is no demand for bonds, and in this case, mortgage rates stay at least as high as they are today. Maybe they even go higher, and that will pull a ton of demand out of the housing market and send prices down perhaps more than 4%. Now, I know that this is frustrating, that all of these things are possible, but I'm just trying to be honest with you and not just make this bold prediction without explaining it. And I encourage you to do the same thing, to start thinking in probabilities. And I know a lot of other people on YouTube speak in absolutes, but that doesn't actually make sense. As an analyst, I am trained to think in what is the most likely thing to happen and also to consider the other things that could happen. So my base case, where prices don't really move that much next year, plus or minus 4% is what I'm saying. That's the most likely scenario, but it's only a 50% chance. That's not a lot of confidence because, frankly, there's just so much going on in the world and the economy right now, it's very hard to predict. The second most likely scenario in my mind is the upside case, where the economy really falters, rates come down, maybe even into the mid-5s. That would really boost housing demand, and we would probably see prices go up more than 4%. The downside case is also possible, but of my 3 main scenarios, I think it's the least possible because I just don't see the economy staying that hot. Remember, the downside case is that mortgage rates stay hot because the economy keeps churning, the Fed keeps rates high, there's low demand for bonds, and so I see that as the third most likely scenario. And then, of course, you also have fringe cases, right? There's so much geopolitical uncertainty right now. There's so much that we just don't know. So we have to acknowledge that there's probably a 5 to 10% chance that something I am not foreseeing at all is going to happen. So if you're wondering how you can invest in even given this opportunity, here's what I recommend. Plan for the most likely scenario and then come up with backup plans if something else comes true. So maybe you agree with me, guys. If you don't, that's perfectly fine. I'm sure you will tell me in the comments, but I'm just telling you what I think the most likelihood scenario is. And because of that, I'm going to make investing decisions right now based on that base case. I think there's a 50% chance that's come true. And I think there are multiple tactics that will work well for me if the base case comes true. I'm going to be looking for cash flow deals because I think that's very important during a risky market. And I think the Midwest offers the best opportunity for cash flow in the United States. So that's where I'm going to be looking. I'm also an accredited investor. I like investing in funds. So I'm going to be investing in lending funds and maybe single family residence funds as well. That's the base case. But at the same time, I'm saying that there's a 15, maybe 20% chance that the market declines more than 4%. And so if that comes to fruition, I have to change my investing plan. So I already know what I'm going to do. If we do that, then I'm going to focus on lending, and I'm also going to focus only on really affordable markets because I believe affordability is the crux of the 2024 market. And I think that markets that are more affordable right now will be more resilient. So that's the downside case. But if I'm wrong and there's an upside case and housing market starts to go up, I got a plan for that too. Then I'm going to start doing opportunistic value add. I'll start investing in some of the higher priced markets that I invest in, and I'll be looking for longer term holds, particularly in the Southeast, because there are great fundamentals in that area of the country. So hopefully you see how I'm thinking about this, right? And I encourage you to do this for yourself. Even if you disagree with my scenarios, even if you disagree with my probabilities, do this for yourself. Decide what you think the most likely scenario is for 2024 and develop an investing plan that goes with it. But also create backup plans in case one of these other scenarios unfold. By doing that, you can make your business resilient enough and adaptive enough to succeed despite whatever scenario comes true in 2024. Guys, thank you so much for watching this. I hope this has been helpful for you in thinking through how to allocate resources and how to invest successfully in 2024. For BiggerPockets, I'm Dave Meyer. Thanks so much for watching.